Hey everyone, today we're covering gap card funding as part of our larger series covering benefit funding models. I'm Ralph Spagnuola, partner here at Nava. I've been in the insurance industry for over 20 years on the insurance carrier side and the benefit consulting side, focused on improving companies' benefits, lighten the lift for the HR team, and leveling up the employee benefit experience. Today I'm joined by Joe Donovan, the CEO of the Difference Card, longtime industry friend. Joe, can you tell us a little bit about your role and what led you here?
Sure. Thanks, Ralph. So Joe Donovan, CEO of the Difference Card, as Ralph had mentioned, and I've spent a long time in the gap funded space. What's been fun for me is I first joined the Difference Card in 2008, so a long time ago, and the space has come a long way. And it's been, at the time, we were about 5 or 6 employees, and now we're well over 100 employees. So being at the helm is really exciting for me. I've only worked in the benefit space. I've been on the insurance carrier side, like Ralph. I've been on the broker side, like Ralph, and then I've spent the majority of my time on the gap funded side, which we'll talk about more today.
Thanks, Joe. We really appreciate you joining us. Again, our goal, give you a deeper but approachable look at gap card funding over the next 20 minutes. So let's dig in. All right, let's start with Joe. What is gap card funding and how does it work?
Sure. Starting with the basics. Gap card funding, the way I think about it, it's a way to build a health plan that takes advantage of what the big guys do and go truly self-funded. And then what typically smaller companies do is fully insured. And what I mean by that is fully insured has very stable cash flow, very low risk. And those are nice things. Self-insured, a lot more risk, cash flow fluctuations, but in return, you get access to a ton of data and typically more cost effective. And the Difference Card sits in the middle between that fully insured and that self-funded option for employer groups. And to give you an example of how this works, I'll take you back many moons ago when I first started in the gap funded space. Most plans going back to 2007, 2008 had 100% coverage. And what I mean by that is you had an office visit copay, you had prescription copays and an ER copay. But if you went into the hospital, it was typically covered 100%, so no out-of-pocket cost. And to use an example, let's pretend 100 employee company is paying $1 million in premium for that rich plan. What became very popular back then was to implement a $500 hospital copay. So put in a $500 inpatient copay, whether you're admitted for one night or a week or a month, God forbid, you paid a $500 hospital copay. And believe it or not, to make that one plan design change, going from 100% coverage to a $500 copay, typically generated about 5% premium savings. So if you remember my example, Ralph, we had $1 million in premium. We reduced that by 5%. That's a $50,000 savings. And if you do the math, how many $500 copays would I have to reimburse to eat up all of those savings? And the answer is 100. So if I have 100 employees and I have to have 100 inpatient admissions just to break even, so it became, the Difference Card where I work today, and these gap funded companies sprung up to say, hey, we can help you self-insure the nickels and dimes of the plan, the copays, like my copay differential there. And if your employees don't use it like crazy, you should end up with some savings at the end of the year. And that was back then. If you fast forward to today, we can, we and other organizations like us can code on 14, 17, 18 different plan areas to bridge those gaps and achieve those savings. So that's basically, gap funding in a nutshell, taking advantage of the fully insured risk tolerance and combining with some of the flexibility and cost savings of self-insured and bringing that down to the small to mid-sized employer.
So essentially, you're keeping it on the same policy, increasing certain benefits, and filling in the gap to keep the employees whole with their same benefits.
Exactly, Ralph. And I think the key things with gap funding is it stays on a fully insured chassis. So some people hear the word self-funded, they're like, oh no, I don't want to do that. I'm too small, or I had a bad experience. The nice thing about the gap funded approach is you remain on a fully insured chassis, if you will, fully insured platform. You put your toe in the water of self-funding.
Right. You're really not exposed to that large liability of a $75,000 stop loss. It's simple and small. That's why it makes sense.
Yep.
Aaron, will you bring up the spectrum slide? So what we've been doing throughout this whole series, Joe, and everybody in the audience, is really gauging of different spectrums of funding that goes along with health insurance. And as you see here, gap card funding, as you mentioned on the fully insured chassis, is towards the left side, but there's no right to left or left to right on this spectrum of funding. It's really what's the best fit for the client and the organization and their appetite for risk. So what's great here is today we're focusing on gap funding, and we have other series throughout this of going all the way to self-insured and fully insured. But Joe, who would be a good candidate for gap card funding?
It's a good question, Rob. It's something that we get often. Honestly, gap funding works in any city, in any state in the country. If I look at our book of business, just thinking about difference card, we have clients in every state. We work with pretty much, any insurance company all the big ones that you can think of off the top of your head, we have clients with right now. When I think about size, typically organizations become a good candidate for gap funding when you reach about 20 employees enrolled in the plan or about $200,000 of premium. Those are the two metrics that we look for. Smaller than that, it gets a little bit more difficult. It gets a little bit, the risk reward isn't quite there. But once you start getting north of 200 or 250,000 of fully insured premium, it's definitely worth kicking the tires. And what I found that it tends to work really well for organizations who value rich benefits. So remember, in my $500 hospital copay example, if you already had the $500 hospital copay, well, there's nothing, we can't get that 5%. You've already taken that 5%. So organizations that have richer than average benefits tend to be really good candidates for the difference card because we can achieve that savings and then also bridge back and make sure the employees aren't feeling the brunt of that out-of-pocket cost. And I look, oftentimes folks will say what industries work best. There's really not a best, but if I had to look at our, call it 1,500 clients, and if I had to look at some concentrations, if you will, nonprofits, public sector business, schools, which I could kind of go back into the public sector business, but even private schools. And then there's your run of the mill, your finance, your technology, your white collar, but we have a lot of blue collar companies as well. So not a great answer because I don't think there is a niche here. It's really any organization that values benefits.
And about so the minimum's on 20, and when is a company too large, if that even exists?
Yeah, that's a good question. I think our largest client's probably 3,000 employees, 4,000 employees. It's hard to, if I go by eligibles versus enrolled. When groups go truly self-funded, so oftentimes they'll do a gap funded approach for a couple of years, get some data, get some cost savings and say, hey, I put my toe in the water. Now I'm more comfortable to take the full plunge, if you will. So I think that really is on a case-by-case basis. As you know, there's no golden rule of when you should or shouldn't be self-funded. It's really the appetite for the stop loss carriers, and a lot of things go into working up that proposal.
Makes a lot of sense. And from our experience, in my experience working with the gap card funding solution, 9 out of 10 times the employer doesn't have to change their insurance carrier or their insurance policy. Is that normal with the gap card funding?
Yeah, Ralph, that's a good point. I think we oftentimes, the vast majority do not change insurance companies. I mean, it's a pain. I don't have to tell HR folks that. The carrier networks are getting pretty close between your Aetnas, your Cignas, your Uniteds, your Blue Crosses. The networks are all pretty similar, but still, it's a new ID card. It's new enrollment. It's a hassle. And I think one of the nice things about the difference card is we typically do not have to change insurance companies. Because why do you change insurance companies? It's typically because costs go up. So if there was a way to reduce those costs and stay with your same providers, wouldn't that be a win? And I think that's why organizations do use offerings like the difference card or gap funded to stay with their carrier.
Yeah, makes a lot of sense. We've seen success with it as well. So now let's break it down, Joe. How about the employee, the member experience, right? When we're working with HR teams and explaining this, how does it impact the member? How do they use it?
Yeah, maybe I'll start with HR, Ralph, because I'd be lying if I told HR folks that gap funding is not an extra step. I think it's important to look at the track record of the organization you're partnering with. Like, have they done it before? How long have they been doing it? Where have they done it? And when I look at our client base and look where it goes really well with HR teams, it's often tied. There's a correlation between how HR folks view education, employee education. Because I'll tell you, if you want to roll out a gap funded program, you don't believe in enrollment meetings or at least or have a way to send out videos to your employees to educate them or materials, it's probably not going to go well because the gap funding is an extra step. It is something different. I mean, you can't keep, people always clamor for savings and complain about the cost of healthcare. You can't do the same things year in and year out and expect the cost to go down. That's just not going to happen. So there needs to be an element of change and an element of education. When I look at the groups that go really well during implementation, it's those HR teams that value employee education and those employee meetings. And most of them are virtual nowadays, which makes it even easier, but to give the employees the opportunity to learn about the extra step that is the gap funding card.
So if we take a pause there on the HR and really partnering with the brokerage team to really deliver the message on how it works, take the time to understand it does benefit the member or the employee, a way to control costs and control their contribution is one of the big wins if the HR team is really willing to put it in the effort and not a ton of work, but educating their staff.
Yep.
All right, so now let's switch to the employee after we explain to them and HR gives us the floor to kind of communicate to the employee how it impacts them.
Yep. So on the employee side, it's, first and foremost, if we issue members an actual difference card. So I think we had an example of one of those. We'll pull up, it's not exactly what a difference card looks like, but you'll see that there you get a physical credit card. And on every one of those physical credit cards, it is a MasterCard, says difference card on it. On every single one of those credit cards, our company's member service phone number is listed on it. So it's literally printed into the plastic, so it cannot come off. And we do measure all of those calls we get. And I'll tell you right now, just being honest, first couple months, first month 1, 2, and 3 is the highest volume of calls. And then it levels out as employees understand, remind themselves of how to use it. Because as good as we try to do enrollment meetings, employees are oftentimes distracted or not paying super attention because they don't plan on using the plan. And then when they actually use the plan, like, oh my gosh, how do I use this card? So we try to make it as easy as possible. And if you think about it, there's a bunch of numbers on the screen right here, but let's just pick one. If left-hand side, if you were an organization that currently had the plan design on the left-hand side, $25 primary care visit, let's just focus on the $25 primary care visit up top. You look at the middle, that's a stripped down version of a plan. So same carrier, let's pretend for a second, same insurance company, but now that primary care visit's gone up to $45. The typical approach during open enrollment is, sorry team, costs are going up. We had to make plan design changes. You now have a $45 copay. Sorry about your luck. Hopefully you don't use the plan because it's now more expensive. With the difference card, our difference card would fund all of those differences in the middle, or could fund all of those differences in the middle. The beauty behind gap funding is you get to pick and choose how you want to fund the card. But in this simple example here, if the employee had a $45 primary care visit and the employer didn't want to push that cost onto the employee, they could fund the gap funded card with that $20 difference. And if you look on the right-hand side, that's what the employee would feel at the end of the day. And if you look closely, you'll notice that the plan on the right matches the plan on the left. So we're not pushing any additional cost onto the member, which is a win. And the other kind of sneaky win that I think members and employers enjoy is it's no secret that costs are going up. And we found that member satisfaction with their health plan actually goes up when you use something like the difference card or a gap funded approach. And that may seem nonsensical because it's an extra step. But I'll tell you why, Ralph, is when members get that statement in the mail that says you now have a $5,000 deductible, that's a number they have never seen before. That's a big number. And what's sad is that too many folks in our country have that deductible with no gap funding help. They have those large deductibles. And when you think about the employee opening up that statement saying I owe $5,000 and then utilizing a gap funded approach or a difference card as an example, and they know that their employer is actually funding that back, they really feel appreciative of the benefit. So it's just something that we found with our clients. And when they do move forward with the difference card, the employees understand the plan better and realize how much their employer is contributing when and if they have an actual claim.
Yeah, so I mean, it really brings to the forefront how much the service costs. And going back to it, I mean, that extra step you referred to, it seems like at least for the office visits, it's done at the point of service. My copayment was 25, it went to 45. Now I swipe the card that the company pays that additional 20, and the employee is still responsible for their same copayment amount, keeping them whole.
Exactly, Ralph. That's just something to think about as hopefully folks who listen to this kick the tires and explore this approach. There's a lot of not all companies issue a credit card. Some ask for a paper receipt or an explanation of benefits in the mail. We just found that member satisfaction, if they don't have to outlay the money and you give them that card where they can pay in real time when they take their child to the doctor or they go to the doctor themselves, that just helps with the member satisfaction and convenience factor.
Yeah, there's plenty of data out there to support the majority of care is under the doctor's office or at the pharmacy, where I believe that card does work to make the process simple.
Yep.
So when we look at this, Joe, I mean, what are the potential drawbacks to consider, right? I mean, of what we just talked about to bring the audience up to speed of the what if or what to be concerned about.
Yeah, we've talked about the extra step. So I don't know if it's so much of a drawback, Ralph, as it is going in eyes wide open. As I mentioned earlier in our chat, health plan savings don't typically come from doing things the same way as you've always done them. So gap funding is a change, and understanding it's a change, and understanding that you as the employer now is responsible for some claims. Because remember, if you're fully insured today, your risk is fixed. You have very limited claims data. If you get claims data at all, depending on your state and the carrier with you may not even get access to any claims data. So you really don't care how your people use the plan. When you go and you put your toe in the water of self-funding via a gap-funded program, you now have some skin in the game. So before, it's just the carrier have skin in the game. Now it's the carrier and the employer having skin in the game. Because remember, when the gap-funded card or the difference card swipes, that's the employer paying the bill for that. So I think understanding that you now have a portion of claims you're responsible for, it's as you mentioned earlier, Rob, it's not the $75,000 stop loss. It's the nickels and dimes, it's the copay differentials, it's the deductible differentials, but the employer now does have some skin in the game, and with that skin in the game comes potential significant savings. So I think one potential downside is reimbursement risk. So let's just, my $5,000 deductible example, that was on that slide earlier, that's a big deductible to reimburse. And let's say that like a very, very large portion of the group, statistically unlikely, but did end up in the hospital and needed that deductible reimbursed. That could be significant dollars that a client would reimburse via a gap-funded program. So there are some gap-funded companies out there, like the difference card being one of them, who will actually insure that spend to give you a safety blanket to guarantee that you won't run over X dollars. So I think that has helped us a lot as a business, be able to go into CFOs and HR folks and say, look, we expect your reimbursements to be here, but we guarantee they won't be over this amount, which is given the once again, that security blanket to know if things go awry, we're covered and it won't be extra cost on the organization.
So a lot of the unknown of the funding in the predictable model, but it is nice to have that security blanket of expected and max. And these are risks that are calculated and explained very well. But the extra step and a little more skin in the game is what I'm hearing. But the reward is so great to control the premium and keep your benefits the same, usually with the same insurance carrier.
Yep.
So do I need to set up a separate bank account for this if I was an employer?
It's another great question, Ralph. We recommend that groups use a separate bank account, but from a difference card perspective, it doesn't matter to us what account or what bank, what account, however you use it, as long as it's an account with funds in it, we can administer off of it. So there's no need to do anything, jump through any hoops there. It's pretty easy. We work, as I said, every insurance company out there. We probably have a client with every bank that you could think of.
And as far as the reporting, I mean, the customers getting details of where this money is going when the transaction, often in very detailed reports.
Yeah, but let's quantify that, because sometimes I know HR folks hear detailed reports on claims and their kind of red flags go up from a HIPAA perspective. All reporting is HIPAA compliant. So right. You won't know, like if Ralph and Joe are employees at a company, you will know Ralph spent $20 and Joe spent $100, but you don't get any sort of diagnosis information. So you're not going to know what Ralph went to the doctor for or why Joe went to the doctor, but you will see employee and dollar amount, just so we can back up that the dollars leaving your account are actually your employees. But it is HIPAA compliant and it is aggregated so that we can tell you exactly how many ER visits, how many office visits, how many prescriptions, but you're never going to get any sort of prognosis or diagnosis information.
Right. No sharing of any protected health information. And this is all heavily regulated, the rules that gap card funding has to follow.
Yep.
So if somebody wanted to implement this, what would they need to do?
Yeah, I think, in my opinion, the best way to approach a gap funded strategy, honestly, any strategy that you don't know much about today, is to kick the tires and ask for a quote. If you want to be really proactive, and I know, Nava and Ralph, you do a great job of this, is 6 months in advance, getting a proposal, walking through it. I think for better or worse, I mean, it's the honest truth. Small to mid-sized employers are getting big increases. And whenever you're faced with a big increase at the last minute, you go into kind of panic mode and you're looking at every different option. And when you do that, when you're in that reactive mode, it's hard to really analyze and take a look at all the ins and outs. So even with us, we have clients coming to us at the last minute, 15 days before renewal. And yes, we can implement, but it's much more smooth process if we can educate ahead of time. And from your perspective, Ralph, educate your clients on all their options, right? Gap funded being one of them. And then if the time comes, God forbid, a big renewal increase that you just can't stomach, well, you learned about gap funding, you learned about, option 2, option 3, option 4. So you can make much more educated decision at renewal time. You're not in panic mode there.
Yeah, I mean, that's just an industry challenge with many that we at Nava try to avoid is the preparation, starting the renewal process early, getting the renewal early from the insurance carriers and delivering the solutions, gap card funding and across the spectrum that we showed earlier. And I've even seen it with our clients where they may look at it for 2 years upon renewal before they implement it on any of these funding strategies. So timing is key. We have dozens of clients that have used this approach for well over, almost 2 decades now, with great success. They've been on that model, reviewing the claims experience. For the folks watching us today, we're happy to put you in touch with them if you want to hear firsthand of their experience of how this works. And that's always where the best place to hear it is firsthand. Well, Joe, I mean, I really appreciate it. That's kind of what we wanted to run through today. And in closing, this brings us to the end of our session. Joe, thank you again for joining us. Everybody that joined us today and watched this video, we appreciate it as well. For learning about gap card funding and other funding arrangements that we're doing throughout this series, so please reach out to myself with any questions at ralph@navabenefits.com or the Difference Card team at sales@differencecard.com. So again, we appreciate everyone's time. Joe, thanks again, and everybody have a great day.
Thanks, Ralph.
My pleasure.